Let's take a look at the S&P 500 and see whether you'd be able to wait for the economy to crash before investing any capital. Be honest to yourself as you answer these questions below. Would you invest in the S&P 500 during the red circle, Exhibit A? How about here, Exhibit B? How about here, Exhibit C? How about here, Exhibit D? Finally, how about here, Exhibit E? If you have any common sense at all, you would have probably invested money when the S&P 500 was trading at its March 24, 2020 bottom, Exhibit C. But this is only because of the perfect vision we call hindsight. Now, look again. Without knowing what the future holds, would you still invest as the market is crashing, or would you have waited? Looking at the above chart alone, I can tell you that most people would sell because they're afraid the market will continue to crash. Truth is, nobody can forecast whether the market will go up, down, or stay flat tomorrow. And so, the question of whether you should wait for the economy to crash before investing your capital is really not the best question to ask, because we will only know the market has crashed and finished crashing in hindsight. If you want a hands-off approach to investing, the easiest way is to dollar cost average into your investments. Say you have $12,000 to invest each year. Regardless of whether the market goes up or down, you just invest that $1,000 into the same index mutual fund at the same time each month. This way you average your price and reduce the impact of volatility on your overall purchase, and you buy less when the market is going up and you buy more when the market is going down. The last thing you want to do is time the market, which is exactly what this question is predicated on. Funny story. Peter Lynch managed Fidelity's Magellan Fund, which had an average annual return of 29% over the course of 13 years. However, the average investor in the fund actually lost money. The most obvious reason is typical investors tend to act emotionally and jump in and out of investments based on their short-term results. When something goes down, they get scared and sell at the bottom. When they see headlines about the market going up, they get greedy and get the fear of missing out, FOMO, so they buy at the top. Again, all this said, if you're just thinking about investing passively without doing much research, just dollar cost average into index mutual funds. If you're actually interested in beating the market and accelerating your way to financial freedom, it's actually not that difficult. You just have to educate yourself and position yourself for what's to come. It does take more discipline, analysis, and stomach, but it's very possible. For example, due to all the inflationary money printing that has resulted from the coronavirus, I'm confident commodities will make a comeback from their cyclical lows. It is an inflationary hedge, after all. Commodities are set up perfectly for a mean reversion in an upcoming bull market, yet everyone is still focused on the large-cap tech stocks. If you're interested in learning more about how you can position your portfolio for what's to come with deep value investment ideas targeting 5 to 10x plus returns, I recommend reading Chris McIntosh's research. Chris retired in his late 20s, having made his fortune in asymmetric bets like the New Zealand real estate 64x return, the last commodities bull market 10x Bitcoin, 20x shipping, 27x. He now runs a deep value hedge fund called Glenorchy Capital and shares his research with the wider investing community who cannot access his fund.